Hello all, welcome. This is Shravan Reddy. Today I am going to explain you about Nifty Breadth tools. So, what are Nifty Breadth tools? Capitalized weighted volume tick, capitalized weighted tick, Nifty advanced decline tick. So, first, what is a capitalized weighted volume tick? Capitalized weighted volume tick is the one which talks about the volume of underlying stocks actually. So let me show you here. I'll go back to this, okay, capitalized weighted volume tick on the graph, and I'll show you how it will work for Nifty. Okay, this is Nifty underlying weighted distribution volume advance and decline line. Okay, it captures the volume of the underlying stocks in a capitalized weighted way. Okay, I'm going to expand this one here. So now I'm going to explain it. Okay. So now in a plain language, I'm going to explain. The red bars, whatever you see, are the withdrawals from the market. The green area, what you see here, okay, is the money injection into the market. So once again, I'm reiterating, the red bars talks about money withdrawals and the green area talks about the money injection. Okay, the black line here is the difference between the two, the difference between the money injection and the difference between the money injection versus money withdrawal. So if the black line is above zero, that means money is being pumped into the market. If the black line is below zero, then money is being withdrawn from the market. Okay, you can use this information in various ways. Okay, and reading this information is very important for your index trading, because index is not an asset. Index is an scale that measures the performance of its underlying stocks. If you see here, any index is being formed by its underlying stocks, that is Reliance, Infy, TCS, HDFC Bank, etc., whatever it might be, all the 50 stocks. Okay, by taking those 50 stocks, index will be formed. So, and how an index is formed in a capitalized way. Okay, so what is a capital difference between a capitalized index and a price weighted index? There are only two types of index in this world. One is a capitalized weighted index, and second one is a price weighted index. Okay, and a price weighted index is like Dow Jones. Okay, where the underlying stock prices decides the weightage, their weightage. For example, if you have a stock of around 10,000 rupees, then in a price weighted index, that stock will take the precedence. Okay, there is other factors also will play into picture, but that is the regular way. But 98% of the global indexes, okay, either it can be Nifty, Bank Nifty, S&P 500, SPY, Dow, DAX, all these other indices, okay, are capitalized weighted indices, where they take the free float market capitalization of the underlying stocks into account to build the index. So in India, HDFC Bank is the got the largest weightage in index in our Nifty. The reason is the free float market capitalization is very high. What is a free float market capitalization? Free float market capitalization is the total number of shares that are available for public trading. Okay, so for example, if we have around 1,000 shares available in a stock, and 800 are being kept by institutions and only 200 are being kept by the can be traded by the public, and there is another stock B where 1,000 shares are available and 500 shares are kept by institutional investors, and 500 shares are available for public trading, then the one which have 500 shares which are available with public got the bigger number, will get the bigger number in index. That is how a capitalized weighted index is formed. So now We have applied the same formula here, and we have assigned the capitalized weighted index, and the volume preference will be given based on the formula how Nifty or Bank Nifty is formed. Okay, so that is the reason why this tool is very important for you to have when trading Nifty or Bank Nifty. Okay, in a simple word, okay, if you are seeing this positive, if you are seeing the negative volumes growing, okay, that means it tells that market is going to withdrawals are being more, and so market might come down. Okay, this is a very important information. No other tool in this world will give this information to you. Yeah, ask yourself, okay, when trading Nifty previously, so you might be drawing some lines on the chart, okay, saying that Nifty will retrace it back here to here and there. How can you tell that Nifty will retrace back there? Because you need this kind of information. Okay, based on that, okay, Nifty is here. Now I see that negative volumes are increasing. Maybe there is a retracement possible. Okay, without this information, it's very difficult for us to understand the Nifty movement. Any index movement is decided by its underlying stocks, not by anyone. Okay, if there is a huge sell-off in HDFC Bank, then Nifty might go down drastically. Okay, it's it's a lot of things that takes into picture. So I hope you understand the concept of money flow analytics. This is our best tool available for Nifty trading. Okay, we have similar tool available for Bank Nifty trading also. So I'm going to explain the second tool to you. The second tool, what is the second tool? Okay, the second tool is called Nifty Tick. So what is Nifty Tick does? Okay, a Nifty Tick is just nothing but advances and declines in real market scenario. And how we have created this one is like by taking the difference of the stocks. Okay, so now everyone knows Nifty got 50 stocks, right? Nifty got just 50 stocks. Okay, Nifty got 50 stocks. Okay, and out of that 50 stocks, if 10 stocks are moving up and 40 stocks are moving down, that means the difference is 30, right? Now this talks about that what is the difference of stocks that are moving down. This indicator talks only about that the number of stocks that are moving down is the most important thing actually, or number of stocks, the difference between the up moving and down moving is the number actually. If it is a green line, then talks, okay, here around 34 stocks are around the 40 stocks are moving in an upward direction. Okay, more than 40 stocks are moving in an upward direction. That's why the difference is 34. Okay, here if you see this point, okay, here there are around 40 stocks that are moving down. That means the difference is 40. That means 45 stocks are moving down. So that's why the difference is 40. Hope you understand this simple tool. Okay, this simple tool is very powerful in nature because like no one in the real market can give us tick by tick. What is a tick? Okay, in first, India's minimum tick is 0.05 paise, 0.5 paise. So India's minimum tick is 5 paise. Okay, that is, if a stock moves by 5 paise up, that's called up tick. If a stock moves by 5 paise down, that's called down tick. So if the underlying stocks in Nifty, okay, if 30 underlying stocks in Nifty moves up by 5 paise, okay, moves up by 5 paise, then that means 30 stocks are in uptick. Okay, in the same way, if 20 stocks are moving down by 5 paise, then that means 20 stocks are in down tick. The difference is 10. Okay, the difference is 10. So now in this video, I'm going to explain how to trade using it. It's a very simple thing. Whenever you see the down tick has touched the bottom point, okay, then that means, okay, most of the stocks are in downtrend. Now there might be a chance of some people investing in, for example, if there are 45 stocks that are in downtrend, okay, now there might be a chance to get the 40 out of 45, 10 stocks might pick up. Okay, that is the place you have to take a look. You have to take a, after seeing this one, you have to take a close look into money flow analytics. Okay, you have to understand, okay, here I see a lot of stocks are being in downtrend. Maybe if I follow money flow analytics here, okay, it might take a small reversal. Okay, and please understand, money flow, if money flow analytics is not so high, like here, there is a very little chance of reversal. Okay, and consistently overall withdrawals are very high in the market, right? This information, reading this information is very important. You have to understand the total number of stocks that are going down, and you have to understand the total number of stocks that are moving up, and what is the difference. If we don't understand that simple fundamental formula while we are trading in real time market, then it's a tough game for us. We will face the tough game from the professional traders. See, all these tools we have devised for our Indian retail traders at the lowest price that can be possible. The reason is, we our Indian retail traders should give a tough fight to the professional traders. All these days, Indian retail traders has been suffered, but now with the tools, okay, the age of indicators and stuff, other things, drawing lines was gone. Now try to use these tools, okay, and start seeing the difference. Now I am going to explain the last but not the least, capitalized advanced decline tool. Okay, so this is a tool which is also very important, equally important, on along with the other two. Okay, so what this talks about, as I have mentioned, uh, all the stocks, Nifty is a capitalized weighted index. Okay, so based on the assigned capitalization, how number of stocks are moving up or down. Okay, in the previous example in tick, I have explained you, it's a plane. If a stock moves by 5 paisa up, it will move up. If stock moves 5 paisa by down, it will show it a down tick. But here it is not like that. Okay, the number of up moving stocks, for example, if HDFC Bank got 10% approximately, if Reliance is also got close to 10%, 9 point change percentage, and Infi got around 5 percentage. Okay, these three stocks can make 25% Nifty to move in a single direction. Okay, this is called capitalized weighted movement. Okay, you have to understand whether the assigned free float capitalization is moving in a negative direction or in a positive direction. Okay, these two are two equal lines. Okay, if green line is above 50, that means more than 50% of the assigned capitalization is moving in a positive direction. If red line is above 50, then it says that more than 50% is above, more than 50% of the assigned free float capitalization stocks are moving in a downward direction. Whatever it might be, about here it is somewhere around 70 percentage. Okay, generally during these phases, okay, 70%, when it reaches to 70% or 80%, you can think of for a reversal, small reversal correction, when people are most of the traders trade the reversals. Okay, they want the reversal, they don't trade the trend. Okay, but they want to trade the reversals. For those people, if it reaches somewhere around 70, that means 70% of the assigned free float market capitalization is in moving in a negative direction. There might be chances for people to see this as an investment opportunity, and they'll dump the money. Okay, then this positive indicator will move into an upward direction. Hope this explains a lot, right? So now, with this, I'm going to take a pause here, and I'm going to explain our services. Thanks for listening to me. And here are our services. So Nifty Breadth tools, we get three tools as part of this package: capitalized weighted volume tick, which I have already explained, which talks about money injection and money withdrawal out of the market based on the capitalization formula. Capitalized weightage tick, it talks about uh, uptick and downtick based on the assigned capitalization formula. Nifty advance and decline tick, okay, plain advance and decline tick during for every 5 paisa moment. All these tools you'll get at 299 rupees per week and rupees 999 per month. Think in a simple logical way. Okay, we are giving these tools. If you buy it for per a week, you will the cost of ownership for this particular tool is 60 rupees per day. If you buy for month, the cost of ownership of this tool is just 45 rupees per day. So if you are, let me compare it with the brokerage that you pay. So even if the discounted broker, even if you go with a discounted broker, okay, they are going to charge 20 rupees per buy trade and 20 rupees for sell trade, right? That means you are going to pay 40 rupees as brokerage, okay, plus the STT plus tax, GST plus etc. So everything will make you 58 rupees to 60 rupees per trade. Is per trade. Okay, that means just to take one trade, this is the minimum amount that you are paying for your broker. Okay, so now think about these tools. Without these tools, there is a chance for you to lose this minimum amount 50. So now we are talking about a 45 rupees per day for n number of trades. Even you can take 10 trades, 20 trades, up to you. Okay, we don't charge as per the trade. You just spend 45 rupees per day with more confidence and more information. With the kind of information that you get from these tools, there is a lot of chances for you to win. Okay, that is the reason why we tell people to read the information. Don't start the analysis immediately. First read the information which is available to you. So use the tools which gives you the right information about trading. And drawing lines, drawing images, and doing some artificial projections using some tools, okay, retracement tools, it will not help you at any cost. Read the information. Trading is no different, and trading is always just a simple buy and sell. Okay, and it's facilitated by auction market theory. Okay, this is all I want to tell you, friends. I wish you like this video. If you have any further questions, I request you to reach out to Bearish Bull 1968. Okay, he's the one who leads us. So thanks for watching the video. I wish everyone a great day.